Howard Marks is co-founder of the wildly successful investment firm Oaktree Capital Management. If you don't know what Oaktree is or you've never heard of it, that's totally fine. Think about Howard as just a fantastic investor. What I love about Howard Marks is he's incredibly articulate when it comes to his decision-making and investment philosophy. And that's why his book, The Most Important Thing, Uncommon Sense for the Thoughtful Investor, is packed full of these great lessons. This book is a compilation of Howard's investment memos over time. And what I love about this so much is you could see his thinking leading up to certain catastrophic events like the housing crisis. You could see how he was approaching that and ultimately how he had positioned himself to get through those waters relatively unscathed. When you pair his thinking and commentary before a big event, and then you see the outcome of the event and what his position was, it's almost like he could predict the future. But of course he can't. He doesn't know what or when something's gonna happen. And that brings us to the first of two major concepts that I wanna talk about from this book. The first one is probability. One thing that I love about this book is how Howard Marks frames probability. Just because something happened one way doesn't mean it couldn't have happened another way. The quote I've thought about most from this book is, "There's a big difference between probability and outcome. Probable things fail to happen and improbable things happen all the time. That's one of the most important things you can know about investment risk." My interpretation of this is you need to be prepared for all outcomes, because when you look back and connect the dots, things feel like they were very predictable, when in reality, nobody knew what was going to happen. One thing that comes to mind here is the infamous GameStop trade. Did the person who discovered the GameStop trade and go all in on it make a great investment? Based on the outcome, it couldn't have been better. Did this person predict exactly how the events would unfold in order to get him to this really successful trade? Yeah, maybe pretty close, but it's impossible to know exactly what would happen. You couldn't. You couldn't predict that everyone would jump onto this trade. You couldn't predict that some of the trading platforms would regulate it and shut down trading. All of this stuff was out of control once the balls were in motion. I'm using this as an example of when someone went all in and hit a grand slam to show that, yeah, it was a really successful trade, and in hindsight, it looks like one of the greatest trades ever. But it's important to keep in mind that there were a lot of other ways that this could have played out. It could have taken more time. There could have been more regulation. The Fed could have announced interest rates were going way up right before all this so that the market would tank, and then he would be out of luck. Like, there are a lot of stars that have to align that are out of people's control, even when you make the right decision. So in this case, this person made the right decision and got rewarded for it, but that's not looking into all the other possible outcomes that could have gone a completely different way. In addition to GameStop, we can also talk about AMC. So even though the people that may have invested in AMC thought that it was a good value buy and they wanted to hold it for the long term, no one could predict that when GameStop took off, this idea of meme stocks would come into the general population, and then AMC would be considered a meme stock, and that would have a huge run up like it did. I mean, even though you were right, something that was completely out of your control happened. It turned it into a very lucky outcome. So when we're talking probability, yeah, you could position yourself to make this happen, but a lot of times things out of your control will take effect, and that could really affect the outcome. That brings me to the second most important concept that you can see throughout this book, which is risk. One graph in this book really helped risk click for me. And it's often because when I think high risk, high reward, I don't truly appreciate the risk side of that equation. I think about this graph like this. Let's say you're climbing a tree, and at the bottom of the tree, there are really sturdy branches. And the higher you go on this tree, the more money you get. Well, as you climb up, the branches get less sturdy and less sturdy. And even though you're getting more money, you might be standing on shakier ground. As you get toward the top of the tree, every one of these branches could snap. And not only are you falling to the next branch, you're falling all the way down. And this is something that came through in Howard Marks' book. When you're really going after high risk bets like this, it won't just knock you down a peg. High risk could take you out of the game forever. A quote that really resonated with me from this book is that bullish investors focus on what might work and not what might go wrong. And I'm totally guilty of this. For the last 10 years, all we've been taught is tech stocks go up, startups are risky, and that's good, and all of this sort of stuff. But until recently, we haven't seen the downturn of the market. And it's during this downturn that you start to realize maybe we were on a little bit of a higher branch or a less sturdy branch than we thought we were, or that we were comfortable with. Both Howard Marks and Warren Buffett, and I'm sure plenty of other investors, echo this same concept, which has a lot to do with risk, which is investors' careers are not going to be determined by the huge wins that they have, but limiting the number of losses. Putting it back into the tree analogy, people are going to look at how far you've fallen from unsturdy branches than they are watching you climb to the top 1 or 2 times. We've talked high level about probability and risk, but how am I using these in my day-to-day life? For the last 10 plus years, we've been in strong bull market conditions. And that means that I've been conditioned to focus more on growth than value. Valuations kept getting higher and higher and higher, so the name of the game felt like it was find companies that could grow the fastest and not worry about which ones could fall the farthest. In the tree example I used earlier, everyone seemed to think that the tree branches were sturdier than they were. And that's why you see companies that were up at the top of the trees on the least sturdy branches falling to the ground right now. We have been in a bit of a correction, and I've felt this pain myself, where companies that I've invested in are worth much less than they were 2 or 3 years ago. And I can see that I was not well equipped to handle the downturn. And I was a little bit short-sighted in thinking that this growth would just continue into perpetuity. After reading this, I'm going to shift my focus from being 100% in on growth to a mix between growth and value. I want to find companies that are undervalued, not just relative to others in the sector, but also relative to how they've traded historically. So I have a good proxy as to whether things are more expensive today than they were 5 or 10 years ago. On that, teachings that I heard over and over and over from this book is that investing is a game of discipline. When you've done all of this research and you have a good idea for an investment, it's easy to convince yourself that you've cracked the code, but you haven't. Like we talked about, even with GameStop, even if he did crack the code, there are a lot of things that could happen outside of your control. And if those work against you, there's nothing indistinguishable from being really right and having outside factors make you wrong and being wrong. My final thoughts are this. Play your own game. Stay disciplined, position yourself so that when the markets are good, you make money with everyone else, but when the markets are bad, you have a little bit more protection in place. Howard Marks references a famous Warren Buffett quote, which is, "Only when the tide goes out do you find out who's swimming naked." I hope you found this helpful. If you like this sort of stuff, like high-level investing philosophy, then absolutely check out this book. I would definitely recommend it. There were a lot of times during this book that I found myself highlighting or bookmarking specific anecdotes or lessons. Thank you so much for watching, and I look forward to seeing you in the next one.